All right, so welcome, Nick Lacy, to Chicago. I'm really excited to have you, being that you are our chief portfolio strategist for the firm when it comes to our portfolios and our asset management team. So, how are you doing today?
Fantastic. We're up from Florida where we had a couple hurricanes recently. Everybody seems to be back doing okay.
Yeah.
Little wind, a little water,
Yeah.
little loss of power, but for the most part, all of our associates seem to be doing okay.
Yeah. Well, please share my thoughts. I'm a Florida kid, and just it really hurts to see the damage of the back-to-back hurricanes. So thank you for making the time to fly up here in the midst of all of that. So tell us a little bit about yourself. I see you've been with Raymond James for some time. You run the portfolios here for the firm, and you're a former USF bull like myself. So that's exciting to see another bull in the house today.
Yeah, I graduated USF with full intentions of going to law school. I wanted to be a litigator until I learned what being a litigator meant. Turned out it wasn't for me. I think I jokingly say, turns out arguing is more of a hobby and not a career.
Yeah.
Graduated political science degree, went back to USF, graduated with a finance degree because investing is my passion. And as we mentor people, I always tell them, identify your passion.
Right.
And if you can do that for a living, you'll be successful, as long as you define success loving going to work every day.
That's awesome. So you mentioned investing was your passion. Same here. I started when I was 18 years old. When did you know that you'd be going down this path?
Hard to say when I knew that I was going to go down this path, because in high school I competed in debate and all these other things where my job was to win people over with my let's say conversational skills or debating skills.
Right.
But throughout my middle school years and my high school years, I always worked.
Yeah.
Had a paper route, I was a bus boy, you name it, I did it. And I remember the epiphany I had one day when somebody said, if you put that money in the bank, they will pay you to hold on to it. And at the time, it was like 12% interest.
Wow.
Going back in the early 80s here.
Yeah.
And I said, wait a minute, I can give you this money and you're going to pay me to hold my money and I can get it whenever I want. And it was the power of compounding.
Yeah.
And I was hooked.
It's amazing.
I was probably 10 years old and I was hooked at that time. And even through college, I always invested, loved understanding investing. And it's something that has always made sense to me.
Yeah. I love that. My mom used to, I used to get money for like birthdays and holidays, and she would give me the receipts and show me the interest. It wasn't 12%, it was much lower. And just seeing your money grow when that light bulb goes off, it can be really amazing. And it's amazing to see what you've accomplished in your career. So here at Raymond James, tell us a little bit about what you do as a chief portfolio strategist. What is that? What does it mean? And what's your day-to-day?
I have a lot of different roles at the firm. Yeah. I tell people my day job is overseeing the Freedom portfolios. And really there's a lot of us. There's 34 people on our team. Yeah. But there's really 7 or 8 of us that make the decisions when it comes to Freedom, direction, timing, trading, all that. And then there's a bunch of people that feed us ideas. And everybody has a skill set, and my skill set really is around risk. Like get the risk right. If you get the risk right, everything else is going to take care of itself. Yeah. I spend most of my time around that concept, but I do other things around the firm because the one thing I love about Raymond James that was different than the first firm that I worked for, which I won't name,
all good.
A wonderful firm, but I spent 10 years at a company where if you had a great idea, it didn't matter because that's not how you did things, because we do things this way. Come to Raymond James in 2006, and I'm an idea person. I always have ideas of how to make things better. And basically I was told, show me. Yeah. And I had a boss that was a show me boss. Yeah. He was a data guy. Show me the data, show me the numbers.
I love that.
Prove it to me, and if you can prove it to me, we'll do it. And after about 2 years of being at the firm, I ended up running asset allocation for Freedom. And then a year later, ended up taking over as the head of the platform for Freedom. And it just kind of developed over time. And one thing that I think is unusual in our field, people understand investing in what I do. People understand stocks and bonds and all the intricacies that go into it. Few people can actually talk about it. And it was one of those things that I've been decent at communicating, and I've been decent at talking to people who aren't in the industry. and trying to help them understand what's important, what's not important,
Yeah.
what are some of the things as a novice investor to pay attention to, as a new advisor, what are some of the things important, or how do you teach an old dog new tricks if you've been doing this for a long time? What can we teach them? And I think because that ability that I've had to have those discussions and be able to get people to see the light, per se, in investing,
Yeah.
it's kind of propelled me into the role I'm in today. And then on top of all that, I want to help the firm.
Yeah.
When the opportunity came to become a trustee of the firm's retirement system, I did. And a trustee is where you basically are accountable for the 401k plan, the profit sharing plan, the ESOP. And then the firm decided to create an investment committee for the retirement plan and asked me to chair it. And this was February of 2020. And I jumped at the opportunity because who else doesn't want to kind of eat your own cooking and get all of our analysts involved? And it's across different departments we work with. And I also run allocation strategy for Raymond James. Anytime you see anything from our firm that talks about strategic investing, stocks versus bonds, or U.S. investments versus non-U.S. investments, or large companies versus small companies, all that stuff funnels through us as well because it's all related.
Yeah. That's very impressive. So you mentioned risk earlier, and I want to pivot back to that. How do you set expectations for your team and for clients and advisors during markets where there may be more risk than others?
I think there are two things that I'll point to. First, there's the risk that we all say we're comfortable with, and then there's the reality of when risk occurs. And part of that is level setting. When you sit down and you meet with one of your clients, you talk about risk, but as an industry, when we talk about risk, we talk about volatility, how much something goes up and down. And 30 years of doing this, what I've learned is rarely do people get upset when the volatility is on the way up. This year, last year, volatility, but markets were up considerably. It's when markets are down that investors get the most concern. Therefore, what we tend to focus conversations around risk, when something bad happens, how much money are you likely to lose? And are you okay with that? Because loss is inevitable. And I can tell you, and I can be 95% confident in this, at some point the market's going to drop 25%. How do I know that? Because it does it all the time. 5% of the time the market drops around 25%. And what's important for your clients to understand is when that occurs, not if, when that occurs, how is my portfolio going to respond, and am I okay? If you're a moderate investor, which most people are moderate, we define that as a balanced investment. You have both stocks and bonds. And it's not just one kind of stock, it's a lot of different stocks. It's not just one kind of bond, it's different bonds. It's very diversified. I have a high degree of confidence what that portfolio is going to do in that event. Therefore, when you talk to somebody, you can say, if the market's down 25% or so, and your account's down 15 or 16, how do you respond? And those are the kind of conversations that I like to have. If somebody says, well, 15% is too much for me, the answer is, well, then you're not a moderate investor, which is fine. You're a more conservative investor. And when you start going through the financial planning systems, they're all looking at these different loss thresholds. When we look at investment strategies, what we try to identify, how do you help an investor earn as much money as possible over time without taking more loss than what they're comfortable? And if you focus on the loss, the upside's going to take care of itself.
That's great.
Don't lose more, because the mistake that most investors make is when the market goes down, they assume it's going to get worse. They assume it's different this time, and they typically will sell investments as the market goes down. Then what inevitably happens? Market recovers. Then what do? They say, well, the market's recovered. I'm going to wait for it to come back down, and then I'm going to get back in. As an investor, the best piece of advice I have is stop looking at your statement. If you're a diversified investor, you're going to be fine over time. Over a 2-year period, a 3-year period, a 4-year period, you're going to be fine. It's that 1 year or 6-month period that scares people. And diversification helps them prevent from losing too much at that time. And that's the whole point that we try to focus on, is don't lose more money than what people are comfortable with.
That's a great answer. Well, sometimes you get all the news alerts, your phone's buzzing, you turn on the TV, it's doom and gloom. And for some investors, just that behavioral finance piece that you talked about, that is very important. So you talked a little bit about diversification, and you talked about being diverse in bonds and stocks, but going a little deeper. Not all bonds are the same. Not all stocks are the same. Can you kind of share your thoughts in that area?
Yeah, from a bond perspective, there's really only, for simplification, two types of bonds. Bonds that are strictly interest rate sensitive, treasury bonds, and then those that have credit risk associated with them, corporate bonds. And corporate bonds are going to vary from high quality to lower quality, but they're still credit sensitive. If an investor holds treasuries and corporate bonds and the stock market falls 25%, 99 times out of 100, those treasury bonds are going to rally. The corporate bonds, it's a coin flip. And the lower quality the corporate bonds, the more likely they tend to follow the stock market. Therefore, corporate bonds tend to look more like stocks than they do bonds during risk. And that's why when you start talking about correlation or how markets move together, I'm less worried with how things move together on the way up, and I'm more worried, how do they move together on the way down? Because understanding that risk dynamic is what's so critical.
Yeah. So where do alternative investments play in that diversification? You have the stocks, you have the bonds, you have in the alts, and there's diverse segments within the alts segment.
Alts are hard because when you model out risk or return, you're really modeling out a market. I'll give you an example, US small caps, just as a market. It can be modeled out by looking at a couple of different indices, and there are characteristics. And you can buy that market passively, or you can buy it actively with a manager. When you do that, you have certain expectations. You know what the risk of that market looks like. We call that beta. It's the beta of the market. If you buy a manager, you're getting beta plus alpha. Hopefully the alpha is positive. When you buy an alternative, what you do is you're removing that beta, and what you're buying is that alpha. Well, the alpha is an unknown and unmodeled term. I can't tell you what drives a hedge fund because it's the difference between your longs and your shorts. And what causes, so it's extremely hard to model it out. And you have liquid and less liquid securities. So alternatives become very, very difficult to model out. On the private side, alternatives can be a very effective way to hedge returns, also hedge risks, but they're also not liquid. And you tend to find a lot of private equity in other spaces, but it becomes a pure risk of manager selection. Got to hire the right hedge fund manager. And it should be, over time, uncorrelated to the rest of the market. The problem that I run into is I mainly work in the liquid world, meaning everything that we typically use, you can buy or sell at any time. And if you buy a strategy that's an alternative strategy and you can liquidate it at any time, it means its correlations to the market are higher. You lose a little bit of that benefit, which is why I like the private side. But the private side has its own challenges as well. And another challenge is, what's an alternative?
Depends.
It does depend. I've heard people talk about tips and infrastructure, and I'm like, those are just kind of sectors, industries. So those are some of the things that I caution on alternatives, is make sure you understand the profile of the alternative. Are you buying an active strategy? Where's the liquidity? Are you buying something that's very liquid? And everything always comes down to, what does it cost too? Alternatives tend to be a little bit more expensive.
So we hear this question a lot, active investing versus passive investing. Hey, I'm going to buy an index and just let it sit for 20, 30 years. Or do I hire a manager, someone that is trained at managing risk, finding opportunities? What are your thoughts?
To me, it's like a Reese's peanut butter cup. It's chocolate and peanut butter. I love them both. But together, they're unstoppable. And in some instances, passive is a very good way to invest, specifically U.S. large caps. U.S. large caps in a passive investment have been unstoppable. However, if you bifurcate the market in the last 20 years between growth investments and value investments, growth investments have been extremely hard to keep up with on the active side, because the better those markets do, the larger the companies become in the market. Value, you don't have that. Value companies don't normally grow 100, 200% in a year like you see on the growth side. where growth managers, only maybe 15 to 20% of them have beat the index net of fees. Value, it's like 55% of the managers. So it's not just a clean sweep of index your large cap. It's, well, are you more growth leaning? If so, indexing has worked pretty well. Are you more value leaning? If so, active managers have done well. And as you move your way down the market cap to mid caps and small caps, you tend to have a lot more inefficiencies in those markets, and the index is easier to beat both in mid caps and small caps. Overseas, markets are easy to beat, easier than they are in the US, because you have not only different stocks, you also have different countries and different currencies. And then you have developed markets versus emerging markets. You have all of these pieces. So I would say when we build portfolios, and we do build blended of active passive, we tend to use a lot of US large cap and even some mid cap passive, and then hire some really good active strategies around it. And on fixed income, if you're going to buy treasuries, you probably don't need a manager. You can probably get away with buying a passive vehicle, but then you complement it with a good core plus strategy that can complement that treasury or that US high quality strategy. And always testing the efficacy of that. Does that make sense?
That's a great answer. You actually answered my follow-up question to that. I was going to ask you about mid caps and small caps and international and finding opportunities there, and it sounds like you just nailed that. So talk to me a little bit about, managing bonds and equities together. Is it ideal to do them together, or you think, having your bonds here separately versus your equities separately?
There's no right answer, because it always comes down to it depends on what you're comfortable doing. What I know is it's very easy to forecast bond returns because they're yield instruments. And if you buy a 5-year maturity bond and you hold it for 5 years, your return is going to be your yield. And nothing's going to change that, assuming there's no defaults. And we do a lot of modeling on where are interest rates now, where do you think they're going to be over the next few years, and what does that do to bond prices? And when you're in an environment where yields are here, but you think they're going here, what a really good opportunity to own more bonds than you would normally own. Because not only do you earn the higher yield versus where you think they're going, you also get the ability for your bonds to appreciate as yields migrate towards that future yield. That's what just happened in the last 2 years. We went from an environment where treasuries were 5.5%, and then all of a sudden they're now migrating to 4.75, 4.5%, 4%. And we look at that as an opportunity that says whether you buy individual bonds or a bond manager, whether you buy a bond fund, a bond ETF, regardless of how you do it, as long as you understand the interest rate sensitivity of what you're buying and the credit risk of what you're buying, it's great. However, on the stock side, trying to forecast a forward return expectation is impossible. We're always wrong. And all we're trying to do when we look at the market is simply say, where do you think an investor is going to earn a premium return over the next few years relative to their normal return? And I'll give you small caps just as an example. In the last few years, the market that has struggled the most is U.S. small caps. And it's struggled because higher interest rates impact small companies the most. They're the most debt-ridden. They're the most reliant on revolving credit. And as interest rates moved higher, it's made them less profitable. So they've performed very poorly. Well, as bond yields have started to come down and as interest rates have started to come down, now small caps and mid caps to a lesser degree, but both of those have the opportunity to earn an outsized, I'll say outsized return, meaning not only can they earn their earnings expectations, but they can also earn some multiple expansion or some valuation improvement. And that's kind of a unique opportunity set. So when we look at it, we say U.S. mid caps and small caps have a nice potential for the next few years, but it could change next quarter. You could have small caps like they did in August have the best month they've had in a decade, and then all of a sudden you no longer have that valuation advantage. So you always have to stay on top of these things. So we tend not to spend as much time trying to figure out the return potential of stocks because we're wrong. It's more about, do you think you're going to do better or worse than long-term expectations? And we've been wrong as an industry for 20 years on U.S. large caps because everybody keeps finding a reason to hate U.S. large caps, but they've continuously been the best things to own in the world. That's why even if you're in the market for 30 years like I am, you can always learn.
Yeah.
Learn not to be overconfident, learn to adopt new information, listen to what the market's trying to tell you. And that's kind of what I try to do when I talk to advisors like yourself is listen to what the market is telling you. Don't get overexcited, but don't get overly pessimistic either.
I like that. So you mentioned earlier that you got into this business because you like ideas. From an opportunity standpoint, what are some of the things that you look for, or some of the research that you follow to when you're looking for an opportunity?
Yeah, I read economic papers. That's what I do. I never watch TV unless it's a good baseball game or football game, and it's baseball playoff season, so it's good baseball right now.
Right.
And look, football is pretty exciting because it's still early. Everybody still thinks they have a chance.
Yeah.
It's still early in the season. I don't watch financial news. I don't read a lot of financial papers. What I read is a lot of economic white papers because you tend to get data, and I love data. I have a rule of thumb that says if you're on TV, we call you an entertainer. And you're on TV because you're trying to earn advertising time. And you tend to get a lot of people shouting at each other and, buy, sell. I'm no good at that. I like to read the data, and then we sit down as a team every Monday morning, and we basically say, what were some of the important things that we found out, and how does it apply to what we're doing? And it really comes down to the big three things from the economy. Is the economy growing or shrinking, and is it accelerating or decelerating? How is the jobs market? And then right now, the third thing is where is inflation likely trending? And those are the three big drivers right now that we have to pay attention to. And when you see economic activity picking up, it means that the markets are going to start pricing in an acceleration of earnings, specifically revenue growth, and then higher revenue growth translates to higher earnings growth. And that should give the market a better than normal return if the economy continues to expand at a faster pace than expected. A year ago, we were all talking about a recession. Nobody's talking about that now. So I just say, be opportunistic. Never try to time things because you're going to time it wrong, and lean into things that look attractive.
Love it.
And lean out of things that look less attractive.
Yeah. So last question I ask every guest. Our audience consists of advisors and business owners and executives. So what advice would you give someone that's starting out today? And then what advice would you give the 30-year veteran? You mentioned kind of like yourself, how you're still learning right now.
All right, so the advice I give a new investor would be this. Markets go up 70% of the time. Markets, 67%, but let's round it up, sounds better. 70% of the time. Therefore, the way that you win in the market is by investing all the time and not trying to time things. And if somebody wants to make a lot of money, you don't do it by diversifying. You diversify to make a less risky rate of return, but you keep the money you make. You can earn a high return through concentration, but it's a lot of risk. You keep the money you make by being diversified. That's what I constantly harp on. If you don't look at your statement, what are you likely to do? And that's probably the best thing to do. If you look at your statement all the time, then you're going to be plagued with today's a good day, today's a bad day, tomorrow's a better day. People always ask me, Nick, is today a good day to invest? So ask me tomorrow. I'll let you know if yesterday was any good or not. We're really good at knowing what happened. The thing that I tell people that have been doing this a long time, don't let your biases get in the way. Because if you've been in the market a long time, you've seen a lot. Like I've seen 3 major events in my professional career, starting with, the tech rally and bust, and then global financial crisis, and then COVID. They all 3 were completely different, but yet none of them were supposed to happen. All 3 in my lifetime, they were all once in a lifetime events. So don't fall prey to your own biases by saying, this happened before, therefore this is going to happen again. Adapt, evolve, and learn from what the market's trying to tell you. And it's a better way to be successful in investing because the markets evolve over time.
That's great. Well, listen, it's been a great discussion. Learned a lot. I want to thank you for joining us here in Chicago. Is there anything you want to leave us with today?
Look, I'm not a big Chicago fan, but I'm really pulling for the Bears. I'm pulling for Caleb Williams.
Thank you.
Because the guy looks legit.
Yeah.
The guy looks. I mean, we got Baker in Tampa.
Yeah.
Which Baker's having fun, but I'm pretty impressed with this kid so far. By the way, I'm 53. I can call most people kids and get away with it. But looking forward to him having a good season.
Yeah, it's looking good. So thank you so much for joining us. It's been great. Thank you.
All right, appreciate you asking.
Mm-hmm.